Money is shooting into perceived safe harbors today. The Japanese yen gaining ground. Treasury has advanced. Commodities tumbled after the World Bank pronounced the recession getting deeper and worse than first thought. Michelle has more on the rot that is amidst us. Michelle, good evening.
Good evening, Bernie. And a grim picture painted by the World Bank. It is now estimating that the global economy will contract 2.9%. It had been looking for it to shrink 1.7%. So let's break it down. The World Bank sees the U.S. contracting 3% this year, Japan down 6.8%, and the Eurozone contracting 4.5%. And like a lot of economic forecasts, the World Bank is looking for growth to rebound next year, but at a pace that is weaker than its prior forecast.
When they've described themselves as reducing the forecast, they've reduced them from their own forecasts last time around. But I think the market is a deal ahead of this. I'm not sure that the numbers that they're forecasting are significantly worse than the market. As I say, they're not really any worse than our own forecasts. And I think this is a tactical opportunity for markets to sell off.
Now, the World Bank funds health and development projects in poor countries, and its outlook is bleaker than the International Monetary Fund, which just last week said it plans to revise its estimates modestly higher. The IMF sees the world economy contracting 1.3% this year. Now, in issuing this updated forecast, the World Bank said that unemployment and poverty are set to increase in developing countries because the economy is slow, exports will be weak, and developed nations will not be able to contribute as much in aid. And the World Bank estimates that developing countries in Eastern Europe and Central Asia will be some of the hardest hit. Bernie?
That's not a very happy message from the World Bank there. We need all the help we can get. Michelle, let's look to our man of the hour for some answers here. Lucas Salipo from Natixis here in Hong Kong. He is with me on AC today. Hello, sir.
Hi.
Boy, sometimes it's okay if you go away for the summer and take the summer vacation, what a lot of us were wishing the World Bank did. You know what I mean?
I know what you mean.
Yeah.
But, I mean, World Bank did nothing else than just acknowledging a situation that is very deep, very grim. It's not because you would expect economies to stabilize when you see states getting 1% to 7% stake in the economy. This is what you would expect. And as a matter of fact, you could expect even more than what you have seen up to now. But the problem is that the private sector is not yet reacting and is not going to react for quite some time. Private sector consumers and producers, consumers are over-indebted and they're busy doing something else than spending, just reducing their debt. Producers, look at the capacity utilization number. It's very, very low everywhere, around 65 in the US. How come you can expect people to invest? They have enough equipment to probably work for 2 or 3 years with the current stream of orders. So it's a problem of the private sector. Until you don't have a private sector, you cannot call a recovery, right?
So basically, we have a bipolar disorder out there. All this talk about, oh, we're out of it, we're out of the woods, good times lie ahead. You know, we've seen property prices in certain places, you know, just basically gallop back to where they were before this whole crisis started. This is all stimulus-led. This is all artificial. The patient is still in a coma. It's life support, giving us all the vital signs.
I think there are differences in the market behaviors, in market trends. Real estate and stock market is a different reason why they're rebounding. Real estate is really a stimulus factor. You have a lot of money that has been injected by central banks into banks. Those banks are not really keen on credit. The credit they give is collateralized, so it's for mortgage activity. And by themselves, they're trying to do something with the credit they're not giving as a credit. For the stock market, it's different. I mean, all the people are crazy about this latest stock market developments. Guy, this Dow Jones is 8,300, is not 12,000. It used to be 14,000. So what are we seeing in stock market is a revaluation to levels that are more consistent with an economic recession than they were before. Before, those levels were consistent with panic and with depression everywhere. Now the levels that we're seeing, valuation we're seeing in stock market, are really consistent with weak economy. They're not at all consistent with any kind of recovery, or we're out of the woods, or we see the light at the end of the tunnel yet.
Okay. I want to bring up, somebody's already written us, Lee writes in to the show here on AsiaConf, as you looked at the little bar chart about the World Bank's view on the world world. Here's Lee. Luca, today, like last Monday, really sucked. He's been very technical here. Is there any correlation, any obvious reasoning to the madness? I just thought it'd be cute to bring it up here because this is something a lot of people are asking but don't dare ask as bluntly as Lee has. Something about Mondays, the hangover? What is it? Anything that you can pin your mind to here?
I don't know. I think the market we're seeing now is a very peculiar market. It's a market where the private agents are basically private as non-financial agents are basically absent, and it's a market dominated by banks flows. Banks have oversold stock in the past recession because they need to raise up capital, and capital was so difficult to raise everywhere, so they have to sell assets. And now we are in a situation in which they have to rebalance their holding of stock market. So what we're seeing now is a market that is dominated by financial institutions and not private people who go to stock market and buy stocks like it used to be.
Yeah.
So with this seasonality of Monday, whatever, we can look for something in the bank's behavior. I'm not sure I can give an answer right now, but keep in mind that everything that we're seeing is dominated by banks.
All right.